What's happening? This is Marek from Hustlenomics LLC. And what I'm doing today is I'm going to tell y'all about how y'all can purchase a property, especially if you aren't coming from deep pockets. So, the types of loans that you can get are conventional, if it's your primary, FHA, VA, and investment loans. Let's start off with the ones for the people with the least amount of money. No knock, not hating, or I'm not even disrespecting you, but if you don't have much money, this is for you. If you've served in the military, if you are reservists, you have to have at least 6 years in the reserves, unless you've been deployed federally. And if you're ever did 90 days, I believe, a consecutive active duty, then you qualify for the VA loan. The VA loan lets you purchase a house 0% down. So it's pretty awesome. Now, pushing on, if most people aren't military. So if you have, most people can qualify for a FHA loan if their credit score is halfway decent, meaning if it's above a 600 and you've worked at a job, a W-2 job for more than, it's generally 90 days, that's 3 months, then you can qualify for a FHA loan. And let's say you make $50,000 a year or 55, you can qualify for up to 200,000. I would suggest, push it to the limit, but, do what you do. So if you qualify for up to 200,000, what you can do is you can buy a duplex and you can house hack. And currently, I'm doing a process like that right now. So you get the FHA loan, you purchase the property for 3.5% down plus closing costs. And you can have the seller pay for your closing costs. And then you can rent out the unit you're not living in and collect the cash flow. So basically you're being paid to live at home. Nice, right? So that's what you can do. And most people can qualify for the FHA loan. The only con to the FHA loan is that you have to pay PMI, which is, for those of you who don't know what PMI is, don't trip. It's insurance on your mortgage. So with that insurance on your mortgage, let's say your mortgage let's say you get a mortgage on the house that's $112,000. Let's make it 110. I like round numbers. So with a 3.5% interest rate and with a 3.6% interest rate, and putting down the 3.5% for closing costs, which is about $5,000. Now you owe $105,000. You're paying about $700 for your mortgage. And if you can rent out one of the units for $1,000 or $1,100, that's pretty sweet. But don't forget about PMI, which is about 1% of the total mortgage, or 2%, which is $70. The total mortgage payment. So you pay $70 extra. Not a huge deal, but it does dig into your cash flow. And you do want to refinance out of the FHA loan as soon as possible. Trust me, I'm working on it. But pushing on. Then you have conventional loans. Conventional loans are loans where you can purchase, if you don't go through if you're not qualifying for a VA loan or FHA loan, you can use a conventional loan from the bank. And you can purchase, if it's a primary residence, you can put down as low as 5%, sometimes 10 or 15%, depending on the property. If it's multifamily, duplex, you can put down 15%. If it's not a duplex, if it's a tri or fourplex, I believe you have to put down 20% if it's a primary, which makes no sense because there's other units you can rent out, but that's, the banks see it as a bigger risk, which It doesn't make any sense whatsoever. Pushing on. So, what I believe you should do is you should buy with an FHA loan, buy a duplex or a triplex or a fourplex, because you can put 3.5% down on the biggest multifamily property you can afford, and then you can rent out the units you aren't living in. But if you're too scared to take on huge risk at the beginning, makes sense. Some people are like, I've never done this before, Marek. And I'm like, that's cool. And buy a property you're comfortable with. Buy a $100,000 property. So I did. I bought one that wasn't too crazy expensive. I could have qualified I could have bought a way more expensive property. But I'm like, I've never done this before. So let me, go in slow, just in case there's some issues. And woe and behold, there were some issues. And because I had humbled myself and bought a property way within my price range, I was able to handle the expense. But if I just maxed myself out to the limit, and then there was an expense, that's how foreclosures happen. Yep, that's how they happen. So, and if you're using a conventional loan, you can purchase a property. If you purchase it good enough, you can get paid at closing. Yeah, that's happened. That's happened. Personal experience. You just have to purchase it with enough equity, and it's going to be most likely that's going to be a conventional loan, and it's going to be the interest rate is going to be a little bit higher because it's an investment property. We worked it out. It's 3.9%, which is incredible. But yeah, it cash flows. It's pretty great. So, and last but not least, I'm only going to talk about this briefly because I've never done it, and you should always talk to someone who's done it. Commercial property loans, which I know you got to put down 30%. Doesn't have to be your entire 30%, but you might be able to work out with the seller to where they'll cover your down payment and they'll cover a second mortgage on the property. I don't know. I'm just speculating. Never done it. So, talk to someone who's done it if we're talking about commercial property. But when it comes to residential, yeah, I'm about that. I've done it. I know. I have a pretty good understanding of the process you go through. When it comes to commercial, I want to get into it eventually, but I haven't done it as of yet. Interested. And if you know more about commercial properties than me, if you've done a deal, reach out. But yeah, this is Marek telling y'all about the different types of financing for properties. All right, sign out.